May I welcome you here, and thank you very much indeed for joining us.
Thank you, Stuart. And I'm conscious that when Stuart first invited me to come and speak, he sold it as the kind of culmination, the crescendo of a morning's conference. And now I realise actually it's me standing in the way of your lunch. And so I think probably the wisest, most astute thing for the official spokesman from Her Majesty's loyal opposition to do would be to keep it pretty damn short, and I'll try my best to do that. Really, all I wanted to do, rather than come and do the usual political spiel about how, of course, this is a pivotal moment, and yes, there are 1,001 challenges. I mean, you all know exactly where things stand. There are only a few things that I really wanted to add to the debate that is currently taking place. First of all, the reform agenda that public policymakers are going through right now is pretty finely balanced. My earnest hope, though, is that it is being thought through properly. And for the Labour Party, for the opposition, I wanted to put on the record that there are areas of broad consensus we have with the government on a certain number of things. For example, that concept of learning the lessons of regulatory failures in the past and trying to make this concept of prudential regulation come to life. However, that will eventually manifest itself, what exactly that will mean. We have to support it. Of course, we want a stronger bird's eye systemic overview rather than just a regulatory approach that looks at the thicket of within the forest. And the key thing is, though, that we have that prudential regulatory change enacted in a way that is going to really make an appreciable added difference. The government have chosen to vest a lot of powers in the Bank of England, and the creation of the new Financial Policy Committee is their principal weapon, a tool for promulgating the prudential regulatory regime. My anxieties are about the membership of that Financial Policy Committee, whether it is sufficiently broad to properly do that job of essentially scanning the horizon for the real economy and making sure that it is spotting the next big bubble or crisis wherever it happens to come. And it is a very difficult task to ask them to do that. We've been hearing about the superhuman nature of the next Governor of the Bank of England and how that appointment will be tremendously important because of this massive power, new powers that are being vested in the bank. But that also applies to the Financial Policy Committee as well. I think, yes, we've got to make sure that these sort of macro-prudential tools that we're all now starting to talk about are correct, but that they're also factoring in the impact that they have on growth within the economy. I think the FPC has a remit very much about risk and stability, and of course that is proper, but I fought and lost a battle in the House of Commons to try and also make sure that the FPC had the same requirement to have regard to employment and growth that the Monetary Policy Committee has in the Bank of England. The government didn't accept our recommendations, but I know there are many great figures in the House of Lords who might have a better chance at improving the legislation when it goes through. There are important problems with the checks and accountabilities for the Bank of England. I think those are the scrutiny of how they're doing their job is very important. And crucially, as far as I'm concerned, as a UK parliamentarian, have we really got the balance right in terms of the way we are shaping and steering the European policy regulatory agenda? I personally don't think that we have. I think Whitehall and our regulatory arrangements are being structured as though the be-all and end-all of everything stops within the boundaries of the UK, when in fact it is incredibly important now that we are punching our weight within the European Union and at that international level. So my view is that the government's legislation needs to catch up a little bit with the times. We've got the two bills this year: Financial Services Bill, the Banking Reform Bill. We've got the White Paper due, of course, on Thursday. But are they going to together set out the correct parameters for policy and regulation, not just addressing the last crisis, but possibly also being fit for purpose for the next crises that will inevitably occur? That is the real question that I'm anxious about. Are they going to, together, help promote growth in the economy, because we're just not recovering back the ground that we should be doing coming out of the 2008 period? And are we in danger of having to revisit all these arrangements when and if events overtake the structures that we're putting in place currently? And the main thing I really wanted to emphasize today was the fact that, yes, we have to, be cognizant of the fact that banking and credit are not these sort of great evils in society. They are now a utility. They're a necessity for society. People need credit. Businesses need credit. It is part of the oil of the wheels of society as we know it. We have to make sure that we have banks that work and can lend, but are driven by moderate, rational judgments and not blind dash for short-term high returns. The thing I'm keen on making sure, if we can, is that the pendulum in some of this regulatory and policy debate finds a moderate rest somewhere in the centre, rather than swinging from one extreme to the other. We've got to be very careful in the way we're approaching regulations, not to cure one problem but worsen another. And in particular, the thing that's on my mind currently are the risk weightings of some of the capital requirements that regulators are placing on the banks, and how we've got to make sure we do this in a careful way, aiding virtuous banking practices, but not smothering out the social and economic benefits that we need from the banking sector. And I've said this in debates that we've had in the House of Commons. If you ever want to keep something a secret, say it in a House of Commons debate. We've got to have, I think, strong risk weightings, but they've got to be done in a sensitive way to the impact that those definitions are going to have on the real economy. And that's a very difficult balancing act to strike, but we shouldn't pretend that they don't have a read across into what is going to happen out in the real world. There are very, very clear implications, of course, from all of these European discussions, the Barnier proposals on EU banking policy, and again, the interconnectedness of our regulatory arrangements with those European decisions, I think, is substandard. The Barnier proposals, I think, are going to be of extreme significance. Of course, when Britain was bailed out back in the 2008-9, but we bailed out the banking system at that point, we had to go and ask for state aid permissions to Europe, that somehow our free market in banking was going to be impinged upon, and we needed to ask permission. Well, look at where we are today. The idea that somehow banking and public sovereign bodies are independent, that we don't have an inexorably interrelated connection between public and private in that way, has gone for good. I'm slightly worried that there is some confusion, not least within the British government, about the Barnier proposals that were made last week, and about whether, in fact, there is a new treaty about to be launched on banking, which it doesn't seem to me that was the proposition Barnier was coming up with. He seemed to be proposing, and I think Barroso again has this week also underlined the fact that a lot of this banking supervisory powers for the EBA and others will be done within existing treaties by qualified majority voting. And so the question really is going to be, to what extent does the British government have allies amongst those EU players to ensure that the British view of banking and of the economic approach we want to take can win the day in those particular discussions. Of course, the Spanish bailout will bring some temporary, very temporary respite, but history shows that this is definitely not going to be the end of the matter. And crucially, I think the central question is to what extent the German taxpayer and those other richer northern Eurozone taxpayers are going to tolerate the burden, essentially, of underwriting much of the wider Eurozone. And it is to be hoped that the Germans and others can be persuaded to an enlightened approach that isn't going to take a sort of punitive stick on many of those other countries across the Eurozone, which will have consequences for real people in their lives, in their jobs, and can't be pushed and pushed and pushed forever without some consequence eventually occurring. And so To me, I think we need far more muscular diplomacy, particularly at that European level. We've got the G20 coming up this weekend, where again I think Britain needs to put pressure on Germany and others, especially on that question of the European Central Bank as a lender of last resort. I think that is still a crucial, unresolved question, and it has to be where we go. Martin Wolf in the FT last week was, I think, very prescient in the way he described this sort of second downward leg of the parallel with the Great Depressions in the 1930s, when he said the fear must now be that a wave of banking and sovereign failures might cause a meltdown inside the Eurozone, the closest thing the world now has to the old gold standard. A fiat currency backed by heterogeneous sovereigns is irremediably fragile. And I do think we are in clear territory now where we have to recognise that the Eurozone as a project may well have been very virtuous, but those consequences have not been fundamentally resolved and need to be properly addressed. And that comes to my final point about what we need from the UK Treasury. We've got to have a UK Treasury that recognises economic realities. There is a lot of politics going on right now, and I'm very worried we have a foolish view that is somehow convincing itself that the attractiveness of the UK for capital markets and the low bond yields that we have is somehow singularly a product of the fiscal policy choices of the UK Treasury, and that it's nothing really to do with the monetary policy sovereignty that we have as an advantage because we didn't join the single currency. We need to have a Treasury that recognises the realities of why capital is behaving in the way that it is, and we need a Treasury that focuses very much more on economics and not just on the short-term politics. I very much welcome what the TheCityUK are doing. I really appreciate your report on from the Independent Economist Group. In particular, I like the fact that it was talking about recognising that we may be in balance sheet recession terrain, the quotes about recalibrating deficit reduction plans, about the markets might be readily tolerant of slower fiscal consolidation if for capital investment purposes. These are the sorts of debates that I think have to take place, particularly in the city, because the political realm is very much now in a polarised arrangement, and I think we need to have a proper grown-up and mature debate. Thank you. And enjoy your lunch.